and welcome to Moneylife. This is Sucheta Dalal. So, what are we talking about this week? I'm going to tell you about the many ways of being fooled in a bull market. So, let's start with India's investor population. Remember, I've said this in various video blogs that India's investor population has nearly doubled since the lockdown was forced on us by the horrible COVID virus in March 2020. From about 20 million, the number has almost doubled. In fact, it may even be more than that. And this is very significant because the investor population had languished for almost 2 decades, and there is this sudden gush of investors into the capital market. What does this mean? This means that over half the investors today, nearly 20 million of them, are first-time investors in the stock market. They have been attracted by a ferocious bull run that has allowed so many first-timers to make money. And as I keep saying, in a bull run, everybody is a genius. Look at how the Bombay Stock Exchange Sensex has moved. From the lowest point on 24th March, which is one day after the first hard lockdown, when it was 25,638, in the next 22 months, it has gone up 234%. Which is to close at 60,109 on 19 Jan 2020 when I was doing this. Now, this kind of run, 200% plus, when you compare it to what you would earn on FDs, I mean, it's understandable that people are rushing into the market. Everybody wants a piece of the pie. Now, when this happens, you have all kinds of investors coming into the market. So you have some of the serious tech-savvy traders who study investment literature. They try to understand risks associated with equity and the capital market. But the vast majority is just lured by the ease of online trading and the illusion of high returns, which is constantly being broadcast in social media. In fact, the situation is perfect for the proliferation of stock market scams. It's a big business opportunity, not just for you to invest, but also for fraudsters and scamsters and confidence tricksters, because they're always a step ahead looking at how to take advantage. This is not related to India alone. This is a global trend. People investing, ease of investment, and of course, a huge increase in stock market scams, like I said, is a global trend. And scamsters are always that much smarter. They come up with innovative strategies to fool people. What do regulators do? They try their best. I have to admit that the Securities and Exchange Board of India, like other regulators, has issued periodical warnings, asked investors to be cautious. It's also threatened to crack down on illegal investment advice and tipsters on social media who are entrapping investors. Unfortunately, nobody listens when the going is good. You only wake up when you have a big loss. On 13 January, SEBI in fact completed a relatively quick investigation to crack down on 6 people behind a Telegram channel called Bull Run 2017. This channel was making false and baseless recommendations for trading in cash and derivative segments over the 11-month period, found the regulator. The channel made false claims about having 4 research analysts who they said were ostensibly in the process of getting SEBI registration, which apparently was not true. And yet, how many investors did it manage to attract? 49,000. That's how people just come like flies. SEBI, in its order, again cautions people, says social media channels are being exploited for such fraudulent, deceitful, and unfair trade practices. Common investors should be cautious of being enticed by such schemes, and it may be prudent to independently research investment opportunities. Is anybody listening? After all, research takes a lot of work. Who wants to do that when you can just buy an algo? In fact, absolutely to the contrary, hundreds of fraudulent tip sheets and investment groups, Telegram channels continue to offer hot tips, jackpot earnings, invest for 3 months, you're a millionaire. These are all based on stories. They always cook up a little story, these self-styled experts, so that you're convinced. Each of them manages to get thousands of subscribers. What makes them doubly dangerous these days is they also use paid influencers to give them credibility, to say positive things about them, and to aggressively attack anybody who tries to punch holes in these theories or question what is happening. So it's a one-way street. Subscriptions to algo trading strategies, which promise high and guaranteed returns, also attracting enormous interest. As I've said in previous blogs, subscribe to an algo and you're set to go, you're linked to a broker platform, and it seems like you just have to sit back and count your money. They're seen as a money machine on autopilot, and people who have no time to understand equity investment, who are doing a day job, maybe working from home, will tell you we are into stock market trading. Ask them a few questions, including risks of equity. They're not aware. They think you're a fool to want to know because they have subscribed to this great algo which is making them rich. In fact, top exchange official tells me that 95% of trading volumes today are from options. They go up hundreds of percentage points every few days in different series and in different underlying stocks and index options without attracting major investigation. Now, many of them are powered by automated trading strategies, and it's not possible to keep pace with the newer and newer ways to cheat people. It is you who have to be careful. Third set of investors are even lazier. They simply hand over their savings to, as well as control to their demat accounts, to unregistered portfolio managers who may be brokers, who may be sub-brokers, who may claim they are working with brokers. Nobody bothers to check. They just sign on the dotted line based on word-of-mouth recommendations and, as always, a promise of very high returns. In fact, I have talked about 28 broker defaults on the National Stock Exchange in the same 22 months when we have a ferocious bull run. Many of the failed brokers, it was later found, were running illegal portfolio management services or investment and derivative advisory services, or simply funding their own trading operations and promising to pass on high returns to people who parted with their money. The amounts that have been lost are not small. They're well over 1,000 crores. But because people don't like to talk about losses much, nobody has bothered to collate them. In fact, it is the exchange which ought to have done. And believe me, the chance of recovery is very, very low. And you're going to spend a lot of money in fighting the cases. On 18th Jan, just a few days ago, we reported how hundreds of people around Sholapur, small town in Maharashtra, had lost over 20 crores which they entrusted to a man called Vishal Fate, who had promised high returns investing in the stock market. Did anyone bother to find out? No. They included prominent citizens, doctors, even journalists, and some say he did algo trading, then they say he didn't, then they say he invested in the grey market. Point is, people are, even those who have filed complaints, have lost their money, are clueless about what they gave their money for. They knew the bottom line. He had promised them high returns. Nobody even knows whether he was properly registered with SEBI as an investment advisor or a portfolio manager. Another major scammy play that's going on, I call it the bankruptcy play. This takes advantage of the high level of ignorance among investors about the basic character of equity investment and the inherent risk associated with it. So what people are doing is saying that bankrupt companies which are facing insolvency proceedings are going to be taken over and their stocks are going to boom. Now, this is a hotbed of fraud and manipulation. Let's look at broad numbers. There are over 5,000 companies listed on the BSE, 1,600 on the NSE overlapped. Of these, about 3,000 get traded regularly. And when I say regularly, it can even mean once in 6 months. At any point of them, a few thousand of them are nearly defunct, literally shell companies. Some of them, a few hundreds, are going through the resolution process. These are the ones which are under the radar of fraudsters and manipulators. Pick up the story, a case, the price is about a few paisa. They say that this is going to be taken over. They're watching the resolution proceedings, sometimes a hand in glove with the management, and then the price starts shooting up. So when you bought something at 2 paisa or 5 paisa or 10 paisa, even when it goes to a few rupees, the return can be in hundreds or thousands of percentage points. And so it's easy for smaller people to get in. Many small people whip up huge volumes, and it's easy for the manipulators to make a lot of money by the aggregation of lakhs and lakhs of people coming in like flies to the honeypot. Fortunately, there is no honeypot. A classic example is Syntex Industries, which hit the lower circuit on 11 Jan after the Economic Times talked about two companies having bid for it. I'm not going to get into details because it's not relevant. The point of the article was they said both companies were going to extinguish existing shares, which they are well within their rights to do under the bankruptcy law. What happens? People just erupt in anger. Hundreds of orchestrated mails are bombarded to us. They're all over social media. The letters are identical. They talk about breach of confidentiality by the resolution professional, by the journalist. Actually, it doesn't even matter. We've written about it. We've talked about the anger of investors, ideally to show how little people understand about the bankruptcy process. In fact, have investors forgotten that barring Ruchi Soya and Alok Industries, in almost every other case, the shares are extinguished. There is no big bonanza. In fact, those who take blind bets on social media, based on social media wisdom, rarely bother even with cursory research. Otherwise, they would have known that Bhushan Steel, Bhushan Power, Diwan Housing, Lakshmi Vilas Bank, USLV, another Uttam Value Steel, where people were erupting with anger all over the place, the shares were written off. It is part of the act. It is part of equity investment. When you see the danger signals, you always have the option to sell and get out. Isn't it surprising how many people don't want to do that? And that is questionable because you have to manage risk. So third development is investors turning into whistleblowers. Like I said, vote with your feet, get out, unless there is some pressing reason why you have to hold on to it. But there are a category of people, small numbers I would say, who have turned whistleblowers. And they are after these people, they tape them, they have screenshots, they write to the regulator, which is wonderful. Good Samaritans working to expose market manipulation should not be limited to investigative journalists or the media. People have to come forward and do the work. I like that. But doesn't stop over there. They then begin to aggressively badger journalists to report their findings, which may not all be kosher. I have seen in the last couple of weeks WhatsApp messages where they're name dropping, claiming that the media, including Moneylife and me, are going to write about something when they haven't even bothered to contact me. They claim they have written to the regulator. We don't know whether they have. They say the regulator doesn't answer. Maybe that's true. Again, it's hard to judge. This often makes their motives very suspect, especially when they're constantly on the phone with the promoter of the company as well as the person who is running this operation. Why would you do that? Is this part of social work? I have not been able to understand after my 35 years in journalism. So let's be very clear. Who has the power to regulate? SEBI alone. It has the resources, it has the legal backing, it has the tools, in fact, expensive real-time tracking software, and it has a statutory duty and obligation to investigate and act against price manipulation. And it's doing that. Yeah, sure, it's slow, but it is the regulator that's doing it, right? What one would like is like the Securities and Exchange Commission, it should have an obligation to at least respond to emails and say, we've taken note of it. What does SEC do? It says, we've noted it. They are not obliged to tell you developments or keep you informed, but they say we can come back to you if we need more information. This is the least that SEBI owes to people at a time when they're writing up so many consumer charters, not just for the regulator, but every segment of market intermediaries. Let's hope that happens. Until then, remember the bottom line. There is no alternative to you being vigilant, being a little skeptical, and doing your own research. Happy investing. If you like what I've said, please spread the word, share this. Let's stop few people from being cheated. Thank you.